Hey everyone, welcome to today's Explainer. I'm your host, and today we're jumping right into a deep dive structural audit of Thermo Fisher Scientific's current market position. We're going to digest their Q1 2026 earnings, analyze some very real competitive threats, and evaluate their long-term valuation targets. If you follow the life sciences sector at all, you already know Thermo Fisher is an absolute behemoth. But recent data reveals a really fascinating tug-of-war going on between macroeconomic headwinds and a super aggressive corporate strategy. So here's what we are going to cover today. First, a Q1 2026 financial snapshot. Second, analyzing competitive pressures. Third, how acquisitions are driving EPS growth. Fourth, the Wall Street valuation outlook. And finally, their path to net zero. All right, Section 1, Q1 2026 financial snapshot. Kicking things off, Thermo Fisher posted a massive $11.01 billion in Q1 revenue. That comfortably beat Wall Street's $10.86 billion estimate. And keep in mind, this 6% year-over-year revenue growth actually happened despite having one fewer selling day in the quarter, plus having to fight through tariff and foreign exchange pressures. So honestly, on the surface, this looks like an absolute blowout quarter. But this is where things get really fascinating, because there's a serious contrast going on under the hood. On one hand, they totally crushed the adjusted earnings per share at $5.44. That's roughly 6% growth year over year, easily beating the consensus of $5.24. But on the other hand, organic revenue growth was a sluggish 1%. That exposes a real underlying tension in their core business. In fact, the market reaction to this report was actually slightly negative, with shares sliding a bit in pre-market trading. Why? Well, because investors saw that most of this expansion was being driven by acquisitions and external factors, rather than organic internal momentum. Which brings us right into Section 2, analyzing competitive pressures. The reality is, giants like Danaher and niche players like Sartorius are constantly trying to squeeze Thermo Fisher's pricing power. Danaher is arguably the sharpest rival in core workflows, specifically bioprocessing and diagnostics. Meanwhile, you've got players like Agilent and Waters pressing really hard in the analytical instrument space, particularly when it comes to high-margin regulated testing. And then there's Sartorius, a major threat in single-use systems. In that space, customers can just swap out parts of their workflow without having to overhaul their entire lab stack. That kind of modularity creates direct pricing pressure on Thermo Fisher's consumables. To make matters a bit more complicated, management has flagged a massive $400 million headwind. This is largely driven by a really slow market recovery in China and big shifts in public funding, specifically U.S. federal research cuts and trade tariffs. You know, when academic accounts and lower margin tools suddenly face strict budget constraints, buyers immediately start looking for alternatives. And that is exactly where those competitors we just discussed start chipping away at Thermo Fisher's market share. But hey, they aren't defenseless, far from it. Their massive $1.4 billion annual R&D investment, combined with 22.7% operating margins, creates a wide moat that smaller competitors simply cannot cross. Their absolute strongest defense is their scale. They can bundle instruments, consumables, software, and service across the entire lab workflow. When you are buying their premium hardware, like say a Cryos 5 Cryo-TM microscope, the engineering and validation cycles are so deep that rivals just can't easily match the performance. Okay, moving on to Section 3, acquisitions driving EPS growth. Take a look at this number, 32 cents. This represents the full-year earnings per share addition generated solely by their recent $9 billion acquisition of Clario, which just closed in March 2026. Clario is a huge leader in digital endpoint data solutions for clinical trials. Even on a partial quarter basis in Q1, it added a penny to the adjusted EPS. But looking ahead, it's projected to add a full 32 cents and $900 million in revenue for the full year. And this just highlights how incredibly aggressive their M&A strategy is right now. Alongside that $9 billion Clario deal, they also have the $4.1 billion purchase of the solventum purification business and a $3.1 billion acquisition of Olink to dominate proteomics. Plus, they aren't just buying up companies. They're actively partnering with NVIDIA to integrate AI directly into their lab instrumentation. They are actively widening their recurring revenue base to effectively buy the growth they need to outpace the technological cycles of their competitors. Let's shift gears to Section 4, Wall Street valuation outlook. First up, looking at Q1 normalized EPS, Thermo Fisher's $5.44 is utterly dwarfing its peers. They're generating nearly twice the earnings per share of IQVIA and almost 3 times that of Danaher. This really showcases their incredible operational leverage. I mean, even though a company like Danaher might be growing slightly faster on a pure percentage basis, Thermo Fisher's absolute earnings power is just in a completely different league. And it only builds from here throughout 2026. Wall Street is projecting a massive EPS growth ramp. Analysts expect Q2 to hit $5.71 as selling day and tariff headwinds start to disappear. By Q3, estimates rise to $6.37, which is roughly 10% year-over-year growth. And by Q4, we are looking at a peak of $7.34, marking a massive 20% acceleration. This trajectory tracks squarely within management's raised guidance for the year. Because of this expected acceleration, absolutely zero analysts have a sell rating on the stock right now. None. There are 18 outright buys on the board, 5 outperforms, and just 6 holds. The street clearly believes that Thermo Fisher's operational discipline will successfully absorb those macro headwinds we talked about earlier. When you weigh the current price of around $513 against the Wall Street mean target of $596, the upside is pretty clear. But if you stretch your horizon a bit, Ticker's mid-case model values the company at $788 by the end of 2030. That implies a roughly 54% total return, or about 10% annualized. For a large-cap life sciences company with an investment-grade balance sheet, that upside potential is incredibly compelling. Finally, Section 5, Path to Net Zero. To ground all these abstract financials into physical reality for a moment, the company is actively deploying $20 million into green infrastructure. This includes some massive on-site solar energy systems. They are actively transitioning away from fossil fuels because, well, it's a reflection of their core mission to make the world cleaner, but it's also an absolute necessity for modern, large-scale manufacturing resilience. And they've laid out a very aggressive timeline to get there. They aim to have half of their addressable European sites on 100% renewable electricity by 2025, and all of their US and Canada sites hitting that exact same mark by the end of 2026. Looking further out, they're actually mandating that 90% of their suppliers set science-based targets by 2027, pushing toward a 50% greenhouse gas reduction by 2030 and total net zero by 2050. The execution here is already highly tangible. Right now, over 100 Thermo Fisher sites are fully powered by renewable electricity. They are scaling capacity, offering customers additional speed and capabilities, all completely without the use of fossil fuels. This ensures their business model remains sustainable both environmentally and financially over the long haul. So, I want to leave you with this final thought. Does Thermo Fisher's incredibly aggressive M&A strategy, their massive scale, and that projected 20% EPS ramp justify these sky-high price targets? Or will those $400 million global macro headwinds and relentless competitive pressures ultimately hold the stock back? It is a fascinating dynamic for one of the most important companies in science today. Thank you for joining me for this explainer, and as always, keep questioning the data.